Welcome back to Startup Accounting 101. These are videos for founders, small business owners to understand accounting fundamentals for running a business. Now we're continuing through the financial projections template. It is available for free from score.org. Just go to the template gallery and download this file. I'll have their link in the description below. This video, we are looking at the Diagnostic Tools tab. And this tab, it covers year one, but the diagnostic tools can be used for any year and any set of financials. And there's a note here that says this sheet performs a few tests on your numbers to see if they seem within certain reasonable ranges. Remember, no computer can tell whether your projections are truly well constructed. Only a human can do that. So only you, as the owner of the business, knows for sure. But these tests can at least look for values that are critically out of range. Right. So the diagnostic tools, they cover just general assumptions about the business. And then it'll be looking at your financials to see whether they're reasonable. And of course, the break-even analysis. So these are the different categories that are getting looked at. There's a value that's getting calculated, and then there's a findings section. And these findings and this assessment, it is based on an if-then statement. So the first thing I think to look at is to review an if-then statement in Excel, just to see what the formula looks like. So if I look at the formula, so an if-then statement, it's if or if. So if something, so some sort of formula, whatever you're testing, if it is true, then it's going to spit out this, the first section. If whatever we're testing is not true, then it's going to spit out the second option. So value if true or the value if false. So I think what I'm going to do is when looking at the different diagnostic tools, I'm actually going to look at the finding and sort of explain the if-then statement and sort of what the assessment or what the assumption is in the template of what we're looking for. Then I'm going to show the value what my business has, and then sort of where it comes from in the template. So let's just get started. The first section are the general financing assumptions. So the first one, when kicking off the business, is assessing the owner's cash injection into the business. So what do they want? If the owner's cash injection is more than 0.2 or 20%, if it's greater than 20%, then it's reasonable. So the owner's injection is reasonable if it's more than 20%. If it's not, if it's less than 20%, then the owner's injection might be too low in relation to the amount of money needed. So right now, I'm sitting at 90%. And I'll split the screen just to show how the template is sort of calculating this. So for me, I'm at practically 90%. And so these two, so the general financing assumptions, they both come from the starting point. So this starting point here, 34. Okay, so it's saying in your total funding, what you're going to be using kicking off the business. Owner's equity here is basically what you as the owner, you're infusing into your business. So if it's less than 20%, it might mean that you're giving away too much of your equity to outside investors, or you're taking on quite a lot of debt. And that is generally risky. If you're just taking out a whole bunch of loans or you're maxing out your credit card to fund the business, it's just risky. It means that you really have to perform. Your business has to be profitable right off the bat in order to pay off a huge additional loans or debt amount. So that's why more than 20% is optimal, and I'm sitting at close to 90%. So I'm mostly, as the owner, I'm funding the start of my business. So running to the next one, it's the cash request as a percent of total required funds. It's saying if it's less than 20%. So if the cash request, as in for the total required funds, is less than 20%, then that cash request seems reasonable with respect to the total request. If it's not, so if it's more than 20%, which I'm sitting at 65%, the cash request exceeds 20%, which might be too high. So I'm at 65, and that's from basically this percentage of like the total required funding. It's more than 20%. I mean, I don't see an issue of having more working capital or cash on hand just to start up the business. That way I don't have to, take on that much debt. But let's just play with them a little bit. So let's say I break this $30,000 up, because this cash on hand, I can use it. Okay, I have to do some math here. So let's say I save some for salary and wages. Let's say I actually buy more equipment. I think I'm a little bit light. I didn't know I was a candy making business when I started the template, so I'm buying more equipment. And then let's just say I'm buying more inventory. Maybe I'll split the difference. So I'm gonna go 5,000 here, and I do want some working capital. Okay, so now I've, this $30,000, quote unquote, that I had coming to the business, I'm putting that in other parts, of the business. So now the difference went down to 10%. So now the cash seems reasonable. I will say, take this with a grain of salt. I personally don't see a problem with having more cash on hand, especially as a new business, because when you start out, it's expected for you as a new business owner, the first year you may not be profitable. You may have a lot of lean months, so you want to have as much liquidity and cash on hand to kind of ride through those really rough months. So that's just my take. So moving on to the next section, which are loan assumptions. So I'm going to do these 4 sections together. So we've got commercial loan interest rate, term of months, and then the mortgage interest rate and term in months. So these are all going to be from the starting point, and I think that's here. So I did not adjust the template at all. So mine are all going to be, the interest rate seems reasonable, and the term loan term in months, is also going to be reasonable because I didn't change anything. So right now, okay, so the interest rate, anything less than 6% right now seems it is going to be too low. So when this template was created, if you have a business line of credit or a mortgage less than 6%, it might be too low. If it's greater than that, which I have 9 right now, it probably is reasonable. Now, in terms of the just a line of credit commercial loan, anything more than 120 months might be too long for this type of loan. For the commercial loan, for a mortgage, so if you have actual warehousing building that you're buying. Anything more than 120 might be a little long, might be a little bit too high for this type of loan. So that's just an FYI for you and your particular business. So moving on to the debt service coverage. Here it says that if the value is greater than 1 or 100%, the calculated loan payments relative to operating profit may be too high. If not, the loan payments relative to operating profit seems reasonable. So for this, I actually disagree with the findings, and Google also would agree with me, and here's why. So when I look at this is coming from the financial ratios. I think I talked about this in this video about the ratios. So this comes from 13. So right now, basically I have enough net income to cover my debts, and it's almost a 2-to-1 ratio. So I have 2. This was Hershey's. So Hershey's has 0.3. And Google has the ideal debt service coverage should be 1.25 or 125% or higher for loan approvals. So I think this is backwards. So I'm actually going to change this. So this should be anything, I'll just do 1.25, which is what Google recommended. If it is less than this amount, that would be quote, quote, bad. So this would be, if this is true, then the loan payments may be too high. So that is the way to go. So if I did that, then mine seems reasonable. So I am sitting at close to 2. Hershey's at 0.3, they may have a lot of debt payments, liabilities, that are a little bit too high relative to their overall profitability for Hershey's. So I have changed the formula, and I would recommend you do the same. So moving on to income statements. So we're a gross margin as a percentage of sales. So here, if the gross margin is less than 20%, it may be too low. So the gross margin percentage seems very low if it is less than 20%. I'm sitting at 85.6, so that is more than that. So for me, my gross margin percentage seems reasonable. So that is here. So this is the gross. So this is like up here. And so if what was this? 20%? Ooh. Okay. If your cost of goods sold is 80%, you are in trouble. Like I actually think 20% is too low, because that just means you have 20% less left to pay everything, which includes payroll in the template. So payroll is not baked into COGS like it is for Hershey's. So you would have to have little to no operating expenses, and you're, I guess, not even paying yourself that much. So I personally, I would up this to 50%. Like if your gross margin as a percentage of sales, which is up here, is 50%, I would say that it seems very low, especially if you're a CPG. So if you're actually producing a product, you should aim for at least 50%. Okay. So moving on to the next one, owner's compensation lower limit check. So here it's saying if it's greater than 0, which means if you are paying yourself as an owner any amount of money greater than $0, so if you're paying yourself $1, it means that an owner's compensation amount has been established. So I think so mine is 208. So this is from the payroll tab. If you're paying yourself at all, then it passes this particular diagnostic. So that is here. So you've paid yourself something, anything, then it will pass. If not, then an owner's compensation amount has not been established. So that's something you will want to establish as an owner. Now, going to the owner's compensation upper limit check, that's interesting. Okay, if it's greater than 1 or 100%, then, which is what I have, I'm at close to 300%, the owner's compensation may be too high relative to the profitability of the business. And so, where is that coming from? Okay, so taking this 208 number divided by net income. Okay, so that's actually very similar to the owner's compensation to sales. This is to total sales, so the percentage is much smaller. This is saying relative to overall net income. So the bottom line, I guess they're recommending that for any of the years, the owner should make just as much as the net income. So like the first year would be like 70,000, the second year would be 100K, and then the third year would be like 200K. Is like the upper limit of your business. So that you can check yourself whether that's the case. If it is a highly owner dependent or a service based business, then obviously it would be greater than this amount. If you're providing all of the services to merit this top line revenue, then your amount as the owner and overall payroll amounts will be higher. So that's the caveat for this upper limit check. Next, we're going to go to advertising expense levels as a percentage of sales. So here is if it is less than 2%, which mine currently is less than 2% at 1.5, advertising as a percentage of sales may be too low. So ideally, 2% is considered. What was it saying? Advertising as a percentage of sales seems reasonable. So why don't we adjust that? I don't mind making that adjustment. So this is advertising. So I'm just gonna add maybe starting out I want to advertise more. So I'm just gonna add more until I get to. So every month I'm just gonna keep adding until I get 2%. So let's say I invest more in the beginning of the business, more into advertising. So now advertising a percentage of sales seems reasonable. Okay, great. Moving on. Profitability levels. All right, so here it says if the profitability is less than 0, the business is not showing a profit. So for me, I have a little bit of a profit, so the business is showing a profit. So this is going to be overall net income. And again, when projecting out your business, you do want to ideally project net income versus net losses for your business. So yes, right now it is profitable at 67K, and then profitability as a percentage of sales. Again, this is going to be the common size net income. And here it's saying if it is greater than 20%. So here in net income, if this is 20% or more, then the projection may be too aggressive in stating profitability. I actually agree. So it might be that you're missing some costs, either within the expense section, the payroll section, or the cost of goods. So you might be missing something if right off the bat you're estimating net income of 20% or more. I do not. So for me, my projection does not seem highly unreasonable. So this is, well, double negative. So this seems like a reasonable net income for the business, and all 3 years also meets that standard. So that's for net income. So that's for income statement. So moving on to cash flow statement. Desired operating cash flow levels. So here it's saying if it is less than 0, then the financial projection does not provide the desired levels of cash flow. I do have an amount here, so that gives me the financial projection provides the desired level of cash flow, and that I remember looking at this and disagreeing with what it was pulling from. So here, so this is 32. So this is the cash draw. Like, for me, does it meet the desired cash flow levels? That to me seems like it should be pulling from here. So it should be pulling from 0. Like, in the first year, the business in and of itself, just operating, does not provide the cash flow needed. And we covered this in the cash flow forecast, because I'm putting in some capital, which has now dropped down to $5,000 because of this. And then I need to draw down from the line of credit in order for me to fund the operations of the first year. So for me, actually, so the financial projection does not provide the desired levels of cash flow, which I think is correct. I would have to project out more sales, or less, just cut some of my payroll or operating expenses in order for me to have a net positive cash flow for the year. So I would agree with this assessment, at least for now. And a lot of business owners, I would say to not be surprised if the first year in operations there's a negative cash flow. You're trying to build a sustainable business, and you might need to infuse capital into the business or to pull from the line of credit in order to make it. So that is sort of the first this first line here. Next, we have line of credit drawdowns. So this is where, like, that's this number here. So the line of credit drawdown for me is 32. So I'm going to change this. 32. All right, so with 32, referencing, basically the line of credit drawdown amount, if it's more than 0, which is what I have, so the business will need at least this level of a line of credit, which 70,000 is quite a lot. So starting out in a business, I think a lot of lines of credit is based on your personal credit as a credit owner. So you'll personally guarantee any business credit card or line of credit. So for you, will you have access? Well, I have access to 70 and comfortably maybe $100,000 in credit starting out the business. So this is actually kind of a useful diagnostic tool to have. And of course, if I do not need a line of credit, the balance does not seem to require a line of credit. Okay, so if it's less than 0. So this is if all of the sales exceeds any sort of cash needs. So if it's a positive cash flow, you probably do not need a line of credit. So moving to the next line here, we've got accounts receivable ratio to sales. So here, if it is greater than 3, which should be 30%, accounts receivable amounts seem too high. I right now am sitting at 5.4%, and that is going to be essentially the AR balance. So that's like 47K over the overall sales amount. 700, 800K. So for me, I'm 5%. So with that 5%, the accounts receivable amount as a percentage of sales seems reasonable. So if this was 30%, then that would be a lot. But I will caveat that if you are mostly a wholesale and retail customer, like if all of your sales were, let's say here, like if a majority of your sales was in this bucket, then it is very reasonable actually to have a majority of your sales as AR. So I think that is, where is it? Additional inputs. I think it's this. So if this was 100%, if you had AR collections that are net 30, net 60, net 90, you might meet this threshold where more than 30% of your ending AR balance might be more than 30% of overall sales. And just know that means you will have to have a collection team, an AR team, that's really good about billing your customers and collecting from those customers. And with that amount, you might need a higher line of credit. Like your line of credit is probably going to be much higher if it's going to take you a while to collect from your customers. This is going to be much higher. So you're going to have much higher line of credit needs if the AR balance is, above 30%. So that's just something to be mindful with for AR overall and the overall cash flow impact to the business. So with that, we can move into the balance sheet section. Here, does year one balance sheet balance? I think we reviewed this in the balance sheet video. Where are these? Okay. So that's this one. Here is if this is not 0. So it was talking about this number here. If it's not 0, then the balance sheet is not in balance. Luckily, mine is 0. So it's a check to make sure that the balance sheet does balance. So there's a check here in the Diagnostic Tools. There's also a check already within the balance sheet tab, whether the balance sheet is in or out of balance. Now, next is the debt to equity ratio. So here, so we have a nestled if-then statement. So it kind of starts off with, if it is less than 2, then it is very comfortable. So because it's like 2, or I guess 200, it's the equivalent of 200. I'm going to change this to an actual number. It'll be easier to see that way. And this is going to be in the financial ratios. That's here. So like these are decimal points here in the financial ratios. So in the Diagnostic Tools, I would also have it as decimal points. It's just easier to understand that way. especially given the if-then statement. So it's saying if this is less than 2, which I meet that threshold for debt equity ratio, Hershey's also meets that threshold. It's a very comfortable debt equity ratio if this number is less than 2. Now, it's nestled because it just goes down the line for the assessment. So if it's less than 2, it is gonna pull or assess very comfortable. If it's not, it's gonna go to the next section, and the next section happens to be another if-then statement. So that's how a nestled if-then statement works. So if it's less than 2, it's very comfortable. Then moving on, if it's less than 3, then it is reasonable. So if this number is less than 3, it's reasonable. If not, it moves to the next section. So if it's less than 4, it's getting debt heavy. And of course, if it is not less than 4, so anything greater than 4 here in this value is a heavily indebted company. So you're just taking on a huge amount of debt in relation to the equity. So here, like this section is going to be almost 4 times as much as this section. And when that happens, you're debt heavy as a company. So that's what this ratio is going to assess for your business. And then last but not least, the break-even analysis. Do sales exceed the break-even level? We talked about this at the break-even analysis tab as well. So if it is greater than 0, then obviously anything over your break-even amount means that the sales projection exceeds the projected break-even sales level, which mine exceeds it by about 100K. If you do not meet your break-even levels, whatever you've calculated, then of course the sales projection is less than the break-even amount. Okay, so this is basically taking this this amount. So it's basically taking your sales here, 800 something, minus whatever the yearly break-even amount is, which is about 700 something for me. So for me, I do exceed my break-even level amounts. So with that, we've covered the diagnostic tools. I'm actually going to close this now. So we've covered the diagnostic tools. We have already covered the COGS calculator in the COGS per unit video. So I will link that up here if you need to reference that. And the last video of this template, we will go over amortization and depreciation. So with that, like and comment if you enjoyed this video. Please subscribe, and thanks for watching.